I would like to speculate that you've been bullish with your slides, and if history repeats itself, things are really going to get better in 2023. So, Mark, I'd just like to ask you just one question before I ask in our responder. Rate cut in 2023 April. So, and then I also saw the 2-year has already broken the support line. So is that like the bond markets are telling us as a leading indicator that markets have already bottomed?
Marvin, just to clarify, the 2-year hasn't yet broken its trend. Yes, it's the dollar that's broken its trend, not the 2-year. But if the 2-year just goes sideways by the end of December, early January, it will break its trend line. Too early to say is my answer to you. I think that rates possibly will go a bit higher, but not very much. And if I had to say, I actually would say they've peaked because I think that inflation has peaked.
So it's inflation. So the rate cut, how confident are you on the April 2023 rate cut, despite all the dot plots and the analysts forecasting even a higher rates by that time?
You know, Marvin, I must confess, I'm not really that confident because we might be reading the Fed totally wrong. The inflation is still 7.7%, and it's not going back to 2 tomorrow. In fact, I don't think it's ever going back to 2, which is what they say they want to get to. I think that's quite unrealistic, and I wish they'd stop saying that, because 3.5, that's probably the more appropriate range given the circumstances we live in today. So, I mean, I'm certainly over 50% confident. Otherwise, I wouldn't have said it. But not 100%, somewhere between those two. Yes, we could be wrong. I mean, right now, the Fed is telegraphing simply that it will raise rates at a slower pace, but it hasn't telegraphed that it will stop. The closest we got to that was Atlanta Fed President Raphael Bostic said a couple of days ago that he saw rates maybe 100% higher, if memory serves me right. He said we could do another 100. So that's 50 basis points more than we're forecasting. But at least that was, the first, Fed president to come out and say that would be the terminal rate. That would be the peak.
Great. So let me hold on to you first. And just to make our discussion more interesting, I have invited a global trader here, and let me introduce him properly. He's the president and CEO of COL Trading Institute, a premier educational facility in the Philippines. Let us all welcome Edmund Lee. Hi, Edmund.
Hi, Marvin.
Yeah. So what can you say about the presentation of Mark?
Oh, first off, Mark, excellent presentation. I think, like, from our perspective, especially from the CTS global perspective, like, we agree 100% with what Mark Matthews was talking about. The basics of the basics. You look at inflation and you look at peak interest rates. I think we're also sitting at that camp. You look at PMIs, you look at money supply, you look at commodity prices, even from the futures market. Generally speaking, how we're seeing it is that everything is going to go down in the next 6 months to 1 year. I think the challenge for, generally everyone is to figure out how sticky inflation is going to be with regards to, especially on the energy side. And I think that's going to be the main risk going forward after 2023. But don't get me wrong. I think in this meantime, there's still going to be significant value. Just agreeing to what Mark Matthews was saying, we're also in the camp that we think there's going to be more opportunity elsewhere than the US. If you look at, let's say, valuations in the S&P 500, I think the market is still expecting a single-digit growth for next year, right, on consensus. And don't get me wrong, I think in the individual sectors, you'll probably see outperformance in the US. So, for example, like the banks would probably still do well. Energy would still do well. But again, the big giants of S&P, you're looking at Apple, Microsoft, the FANG, and the big tech. What I worry is that we might still see more derating on that end. So while generally speaking, again, the stronger sectors would start to outperform. This is what we call a bottoming out process, where again, the tech would probably be the laggard this time around. And I think that's the highlight also about Mark Matthews was saying. Again, what we prefer in our end is still emerging market, including the Philippines, especially how we also view that dollar peaked out. We think China is also there. They've started to reopen. I think COVID cases week on week is up 100% to 200,000. It's its record high today. And hopefully China remains open. Valuations, we haven't seen this low. I think they're still pricing in maybe 8-9 times PE next year. It's still, even though no matter how big of a rally we've seen in Hong Kong tech in Hong Kong, they're still trading way below the last 13 years and still very cheap at today's level. So our preference for equity markets is still emerging market in Asia as opposed to the US. But again, for me, I think the first thing that has to rally is the bond market. And I think especially from the affluent or the high net worth individual perspective, right? When you're seeing your economy still continue to grow and your bond rates are still giving you 7.5% for certain countries, for example, like the Philippines and Indonesia, I still think that's the main preference. And this should probably go down first before the equity market will have a sustainable rally.
Wow, thank you for that, Edmund. Mark, your Julius Baer is a large, they have large private bank. And then you have, what do you tell your customers? What do you tell your clients, given this kind of market? Where should they put their money in this part or in any part of the world? Is there some kind of a preference for like emerging markets in Asia? Because yes, you said US might not be there.
Selectively, there are some emerging markets that we like. We like Southeast Asia as a whole. We like India. I mean, China is very cheap, and there are companies that have dividend yields which are just so much higher than their price earnings ratios that I think, you can be paid to wait in owning them. Dividend yields of, upwards of 10% in some cases. Of these big companies listed in Hong Kong. However, I have less faith really in being able to say what the future is there than I do for India, for example. Then outside of the United States, we like Switzerland and Sweden. Those are two very good markets. They have lots of good companies, a lot of transparency, long history of treating minority shareholders with respect, and the rule of law, et cetera, minus all of the, troubles in Europe or the UK. So hope that answers your question, Marvin.
Yeah, thank you. Any other clarifications you have there, Edmund?
No, I think that very clear cut, especially from a macro perspective. One of the challenge for us is that markets are always forward looking. So what has happened over the last 2 months, basically the market has rallied, making certain level of expectations. I mean, just on inflation data last week, you saw the market rally huge, right? It's not that we're out of the woods yet. I don't think that's the question. I mean, you're still looking at Fed still hiking interest rates still end of the year, right? Except that it's a good signal that when you're going through this bottoming out process, all these negative news, in our opinion, to some extent is already priced in the markets today, right? So yes, I mean, we're seeing the rally and markets could still drop, but for us, this bottoming out process is an opportunity for you to start accumulating during this time.
Great. Matthew, Mark, and Edmund, we have a lot of questions. What we did is that we asked the audience advanced questions, and we tried to group them together. And I would like to ask you or Edmund to answer some of these questions from our audience. So let's come up with that. The first question, I think this is grouped together on inflation and global outlook. This is asked by Carlito. I guess I will ask you, Mark, to answer this. In the worst case scenario of the world's various geopolitical tensions, what could happen to an equity investment? I guess they're concerned about China, US, I mean, Russia, Ukraine. I think they're asking,
Well, I mean,
Carlito's asking what happened to equity investments.
the worst case scenario obviously is nuclear war. I have no idea what the market would do, but I don't even want to go there, frankly. Let's say second worst case would be Taiwan. I think you'd see a 30% fall in markets globally, but then markets like the US would come back. And the concern would be that you might not be able to get your money out of China in an event like that. What I want to say is that I think that's highly unlikely. I think the G20 meeting in Bali was much better than expected, and I'm still trying to figure out what happened. But something very positive happened there. You can just tell by everything that's been going on since then. Mm-hmm. And I'd also say I thought it was very interesting. Berkshire Hathaway bought a stake in Taiwan Semiconductor recently for over $4 billion. They very rarely buy anything outside of the United States. They very rarely invest in technology. So I mean, I figure Berkshire must have good contacts in the US government, and they would certainly have good contacts at Apple because they're the largest holder. So I think they must also, if Berkshire is willing to make a big bet in Taiwan, that gives me also extra confidence that the worst case scenarios won't actually take place.
That's good. That's good. Let's take this as second question. What's the difference with bear now? Now, I think the second question is by DC. What will be the killer to the bear market rally? What could be this? Could dampen that, Mark?
It would be that I was wrong. Everything I said was wrong, and the Federal Reserve will continue to raise rates well after December. And that's not impossible. They may decide. I mean, certainly there are so-called hawks within the Federal Reserve, like James Bullard, like Neil Kashkari, and they've been inferring rates could be way, way higher, like, you know, upwards of 8, 9, 10% even, which they got to in the early 80s under Paul Volcker. So, yeah, the answer to the question is that Fed keeps raising rates. That's what will kill the rally.
Yeah, that's right. That's right. So I guess the question by Josie here, any more headwinds expected other than increasing interest rates that can dampen the stock market? Edmund, you might want to add any ideas you have here?
Oh, again, you know, at the end of the day, I think inflation is still the main cause of, the main cause of concern up until today, right? All these geopolitical tensions that are happening outside are just out of our control. So the things that we can see going so far in the next 6 months to 1 year is just really seeing how sticky inflation will be. Right? Yeah, it's very difficult from the services side to reverse what has happened today.
Okay, thank you. Next group of questions. Let's have them. I think this has to do with diversification and portfolio strategy. Question by Cernan. What is the best investment during recession? ETF, bonds, money market, or mutual fund? Where shall I put my money? Edmund, you might want to start.
Like what I said a while ago, I think the bond market should rally first and rally sustainably versus the equity market. I think if you look at previous recessions, for example, like 2008 or 2001, coming from the 1999, the bond market rallied sharply while the equity market was still bottoming out. And I think in 2008, we probably had 8 months of bottoming out process. So that consolidation period near the bottom before it started to break out sustainably, right? And that's the reason why I prefer the bond market first. And I think that, especially with rates today, very attractive today. And I still think that the bonds should rally first and then the equity market should follow.
Right. The next question here by Mel, maybe Mark can answer this. No, given you said, I think you had an example of a 60-40 mix, but I think the question of Mel here includes property, commodities, and other investments. How would you spread the risk of your portfolio for 2023?
Well, property and commodities are very different from equities for a bunch of reasons. There's a cost associated with owning them that is quite high often, depending on what the commodity is or where the property is. But I would say for property, I mean, I don't know if it's investment advice, but everybody should own the home they live in, or at least the home they intend to retire in. And so you shouldn't even really consider that an investment. That's just what you should do. You shouldn't rent your whole life. So you own your property or build up the equity by paying down the mortgage on it over time. And so I would just take it for granted that you own your property. You should. Commodities, I don't see any reason to own commodities long term. They're expensive to hold. They're volatile. Equities are really where you want to be. They have good proven track record of rising over time, and if you just keep holding them, they'll end up doing very well for you.
Right. I think it's related also to the next question. How can you level off the risk in investing while the economy is uncertain? Maybe mix some bonds, mix some cash there, Mark?
The global challenges, how can we level off the risks in investing? There's one thing that some people do is they buy insurance through the futures market in put options, but I wouldn't recommend that. It's too complicated. I don't think you should do that. If you're a long-term investor, you're going to go through occasional bear markets, but thankfully bear markets don't last very long. They usually only last less than a year. And bull markets last a long time. They can last for 10 years. So don't worry about it. Just keep your portfolio. And once in a while, it'll go down. And by the way, those are the good times to buy when it does go down, if you've got cash to buy more. But otherwise, I wouldn't be too complicated. I'd just keep owning.
Yeah, just keep owning.
If I could add.
Sure.
Yeah, if I could add, I think the name of the game, especially in this environment, is to buy defensives also. So one of the aspects that you want to have here is getting paid to wait while you're going through this bottoming out process, right? There's probably still going to be, especially the ones that are still burning, we can probably still see a lot of acquisitions and maybe some fallout in some of the bankruptcies of the ones that are still burning cash. But again, if you're buying companies that are still defensive, still pay out a dividend, still have cash flows that will probably be least affected during this environment, I think that would probably be the best exposure with regards to both the equity market and other asset classes.
So be selective at least, right, Edmund? Right. Thanks. Okay, let's have the other group of questions. I think we have a couple more regarding sector resiliency. Which two industries will recover ahead of the rest? Edmund, can you try this from Al? Which two industries?
Well, I wouldn't say recover because they're still, into new highs. I really believe that the energy sector in general for the US should still hold, even the energy sector here in the Philippines. And the reason why it's because if you look at valuations and the component and their percentage in total S&P, they're still relatively small, right? I think you're still looking at 10, maybe less than 10 times PE for the energy sector as a whole. Free cash flow yield still very, very high. And we're still seeing huge underinvestment in the energy sector as a whole. Even with what's happened the last 2 years, I think we're still seeing a huge underinvestment in the energy sector because nobody wants to start putting in more money in traditional energy assets, right? And I think the energy sector as a whole would probably be still the strongest sector for the next 2-3 years.
Are you limiting it to ESG energy or more even oil and coal?
Even the traditional, in my opinion.
Even traditional. Yeah, okay. The next question is here by Kai. But what do you think about REITs and global property market? You want to answer this, Mark?
I think with REITs, it's important to choose them. And the best REITs are the ones that are backed by parents that have big land banks that can basically sell land at good prices to those REITs, and the REITs can use that land to make lots of money. So I think you have to be a little picky in the REITs. Like anything with property, it's location, and so that, the second half of the question, the global property market, it's all about location. There are some cities that are coming out of COVID actually much stronger than where they were before. I'm in one of them, Singapore. although that's actually more because of what's happening in Hong Kong. But Dubai's coming out very strong. So is Miami. So that's the three golden words in property. And I think I'll leave it at that.
Yeah, but Mark, a lot of our listeners or viewers, our retail investors cannot really access it directly. But how about a fund, a REIT fund? Is that something that they can consider? Global REIT fund?
I don't see why not. I mean, REITs basically are supposed to give you a good yield. And I think the important thing, though, is to own REITs that have quality assets, because there are some that don't. And those assets will be underutilized and won't provide as good returns. So I do think one should be selective in the space, and hopefully a good fund manager can do that.
Right. Okay. Thank you. Next, do we still have a group? Market cycle and portfolio outlook. Question by Joel. How should we react now with the bearish global economy? What are the indicators that the bearish market is ending? I think you answered which company should you invest in. Yeah, I think we answered this. I think Mark clearly that inflation is coming down and probably interest rates will go down. But I guess the question is, which companies should we invest in today? Edwin, you mentioned some of these companies.
Well, I mean, I guess this is from a global perspective, right?
Yeah.
I mean, for us, when we're looking at it from a macro perspective, again, we still prefer emerging market plus Asia. So our priority is that growth would probably still be there, especially both from a valuation perspective and from a growth perspective, right? And we think still not just from what I talked about the energy side, but as a whole. So I think even on the consumer staples side, and especially consumption-driven countries should probably be the leading countries going forward out of this recession.
Yeah. Ito pa, second question by Emerson Edmund. It's about, I guess, trading. No? How to effectively cut losses during stock market crash and bearish situation.
What I'd like to share to people, especially those that are trading in this environment, is that you'll see a lot of volatility and a lot of shakeouts and a lot of fakeouts, right? Especially when you're coming from a bottoming out process where the sentiment is still very poor in general, right? So you probably won't have, how would I put it, like strong sustainability in uptrends. It's probably going to be very choppy in this regard. So that's the reason why during this environment, we try to put a different hat on, right? You try to put an investing hat on. Understand that this is going to take time, right? But again, if you ask us, like holding through this volatility should definitely pay out, maybe in the end of next year, maybe mid next year to end of next year. And I think that's how we're approaching it. Instead of trying to put a trading hat on, you should actually put your investing hat on.
Investing hat on. Now the opportunity comes in. Mark, no, the Teddy question here. Should I continue to buy the strong dollar? I don't know. I think you mentioned it's going to weaken to add more to U.S. global funds.
Well, if you're investing in U.S. stocks, you have to be buying the dollar, don't you? I don't think the dollar is going to collapse. I just don't think it's going to go up as fast, or I don't think it's going to go up. I do think it'll probably next year be weaker, but that doesn't, it's small price to pay for getting access to the U.S. market, which I think is a good market over time. So I wouldn't go out of my way to own dollars, but if I wanted to buy U.S. funds, then I would do it regardless of whether I thought the dollar was going to be a bit weaker 12 months from now or not.
Yeah, right. All right. Thank you for that. Do we still have a group of questions here before we go to the live questions? Ladies, do we still have? Okay. We have some live questions. I've seen a lot of Q&A in the Q&A tab, and probably we can ask help from our ladies here to flash some of them so we can take some of these live questions from our audience. It's been interesting to see that things are getting to be a little better. I mean, there's a lot of opportunities that you're sharing with us, at least for next year. Any questions from the live now? Can you flash it? Here, from Rahina. Hi, Mark. You mentioned the overall inflation basket shows a downtrend in commodity prices and uptick in services prices. More specifically, can you share your 2023 outlook on number one, energy and wages inflation, and number two, global supply chain situation? From Regina.
Well, energy, if I just use the oil price, we look for the oil price to be pretty much exactly where it is today, 12 months from now, about $80 to $85 a barrel. And I guess the reason is that OPEC still has an influence on the prices, and it doesn't really want to see the price go much below 80. Wage inflation is a big thing all around the world. I think COVID really caused a sort of a psychological reassessment of a lot of people in their lives and how they wanted to live their lives. And I'm not quite sure how they survive without a wage, but a lot of people have dropped out of the workforce around the world. I see it here in Singapore. It's extremely difficult to get served in a restaurant these days. There aren't enough staff. So I think the wage inflation will continue, but that's actually not a bad thing because it helps people, offset the higher prices of things. So I think actually the wage inflation, if there's one thing that'll prevent a recession in America next year, I think it will be the fact that wages are rising. And so people aren't being hurt so badly by inflation as they would be if there was no wage price increase.
Mm-hmm.
The global supply chain, I think, will continue to improve. It already has. Freight rates are where they were before COVID. I think that's well behind us now.
Good. Well behind us now. Thank you for that. Let's have another question from the audience, from Shane. Given an environment where 1, Fed rate hike slows down, 2, inflation decreases, 3, dollar weakens, 4, possible recession on developed markets, where would global funds flow? Would emerging markets be a safer bet? Edmund, you'd like to take a snap?
I think you answered your own question, in my opinion. Just to give you also an insight, coming from 2008, the emerging markets actually rallied earlier than the S&P 500 and the US, right? Making that same playbook today, we think that's what's going to happen also in this today. The reason why it's because we didn't go up as much as the US anyway in the last 2.5 years coming from COVID. S&P, obviously, many stocks still up 40-50% from where they come from their previous peaks in 2019. Emerging market we just recovered from COVID, if you think about it. And that's the reason why we think there's probably going to be more upside for emerging markets, especially from, again, we talked about valuation perspective. Just look at the Philippines. It's still at 13.5, 14 times PE. This is compared to much higher in terms of historical bands, while US is still in that relatively expensive zone or fairly valued zone, like what Mark Matthews was showing a while ago.
Thanks for that, Edmund. But emerging markets has China. As a whole, emerging market, China is still there. It's a big component of emerging market. But do we take that out because of the COVID, or emerging market as a whole is fine?
I totally understand why there's going to be plenty of hesitation with regards to China because of transparency, because of Taiwan, because of geopolitical risk, right? But one thing that everybody has to know is that if you look at what happened coming from the National Party, is that center of control now with President Xi. That's the worry about going to third term. We think that is already done. That part, he already has the control going forward. It's still a risk in our opinion, but coming from that National Congress, and now he has centralized power. Now, after that, China is starting to let COVID start to pass by. Now, the president now is allowing more risk to happen because you already have that extension for third term. And hopefully that is sustained. And, Hong Kong is trading at what? 25-year low in terms of index. I think we've never seen anything like today. And again, there's just huge yield. Valuations are cheap. You're coming from a very, very low base for China. And while I do understand that there is risk, I think you'd probably have more white swans than black swans at this level.
Great, great. Let's get a couple more questions, and probably I'll ask you some last few words as we try to end this later. But let's get a couple more questions from the audience. From Andrew: will foreign outflows from China limit its potential or contribute to global weakness? Or can China pivot out of this weakness and overcome this to be a contributing factor to the global economy? I think this is China versus US. Edmund, you want to continue what you're saying there about China.
You know, nobody really knows, let's be honest, right? But when I look at foreign outflows, I mean, in the last 8 months, we've had 2 reports. I won't say from which private bank, but both of them at the lows, both said that China is uninvestable. Right. And it happened twice in the last, I think, twice this year. Right. And at this stage, I mean, you look at from the US or even from the fund perspective, China is probably the least of the, I mean, if you had to pick a list of countries where you want to invest, China is probably not existent in that regard. So if you ask me from an outflow perspective, I mean, nobody's there anyway. Right. So to pivot out of this weakness because of what's happening today, I think there's going to be several opportunity also from Hong Kong and China.
Yeah,
I mean, just to give you additional.
Yeah, thanks.
Background.
Thanks. Mark, can you add anything on that, on the China perspective? Is it an opportunity for investors to look at China now?
I'm really torn by the valuations, which are extreme. And when I mean that, I mean extremely cheap, and the uncertainty about the future. So there are 2 main things: the property sector and COVID. And property sector, they are now giving loans to banks to allow them to complete existing projects, so that the customers who bought those will get the things they paid for. But beyond that, with property sales so weak, I don't know if any bank, unless its arm is twisted by the government, will make additional loans for new property developments to the developers. And the developers' property sector in general is such a big part of the economy. It's sort of a big hole that's going to take a while to be filled. And then with COVID, I think they would like to lift the restrictions, but the problem is that they've really communicated a message on COVID, which is so what's the word?
Extreme.
Well, okay, the people are terrified. So there was one city 100 kilometers south of Beijing called Shijiazhuang. Believe it or not, there's 10 million people there. Anyway, the rumor was it was supposed to be the test case for removing all the restrictions. And rather than celebrate, the townsfolk all panicked and took their children out of school and stopped taking the subway and rushed to the pharmacies to buy traditional Chinese medicine. So it's going to take a while to change people's minds. And the Chinese have been adhering to this zero COVID for so long. I think their immune systems are probably not up to just withstanding a lot of bugs floating around. So every country, unfortunately, has to walk through this valley. I don't think there's any escape. And how they handle that, I'm not sure. They'd like to open up, but the people might not do it. They might just say, I don't want to.
Right. Oh, so we have just to let you know, our audience can access these countries, China, including US, through funds, but not directly, of course. But we have global funds in our platform that our retail investors can access. That's why we're having this session. So it's very interesting for you to give us some perspective, Matthew, Mark, and Edmund. For our last question, can we bring this up before we end this session? Live question from the audience from Conrado. Hello, Mark. How should an active investor like myself rebalance my equity portfolio to address the short-term risk and at the same time take advantage of the medium to long-term opportunities? How do you balance your equity portfolio? Mark?
Well, I think an honest question deserves an honest answer. So the best of my ability, I think that we've already gone up 12% in just a few weeks, which is really quite big for the S&P. And I think maybe we've got 3, 4, 5% between now and the end of the month, but I think we are going to get a pullback soon. So that's your short term. I think actually it's getting very close to taking chips off the table. But then medium to longer term, I think and I hope, some of the data that I showed you suggests, even if we don't know exactly why, that history shows markets usually are quite a bit higher after they go through the same kind of conditions that we're in now. And so, I'm not telling Conrado to sell just to try to, because I don't know how to trade myself. Actually, Edmund's the person to answer the question. But if you really ask me, I think we're getting close to the top of this, and then we come back down, but then we can still get a rally into the end of the year, and then next year I think will probably be a good year.
Edmund, you want to add to this?
Yeah, no, I think that's what I mentioned a while ago. While I don't think we're out of the woods, meaning because we're still raising interest rates, so it's going to be a bottoming out process. So we think it's still going to be volatile in the short term. So meaning we're at the top end, like what Mark was saying a while ago. We think we're slightly at the resistance. You should actually be trying to take profits off the table. But again, the timing aspect is going to be very difficult when you're going through volatility, such as today. But again, it's still a buy low, sell high environment for us. So for us, if prices go down, we don't think, so far, we're going to see like a huge systemic risk, right? So we think that every time markets start to go down, we see it as an opportunity to start buying.
Yes, opportunity to start buying. Great. So I think we are running out of time. Maybe we can ask you some few words or some closing remarks. Discussions have been very interesting, especially the slides that you presented, Mark, that things probably be getting better for the coming months, and the statistics that if history repeats itself, wow, that's really very interesting. Mark, any last few words for our audience so they can be more guided for next year?
Oh, my only words are thank you for listening to me, and it was a real honor to be here.
Great. Thank you very much for your time. And probably we can have you again when you visit the Philippines as well.
Well, thank you.
Edmund, anything can add?
Yeah, first off, I'd like to thank Mark for coming here. I think he gave an excellent presentation for everybody to be guided, right? Just maybe one last thing is that, when all the good things or all the good news start to come out and you look at the economy, it's already recovered. I'll tell you, the equity market and the bond market is going to be up there, not in. Right. So if you wait for all the good news to start coming out, where the economy is fully recovered, we're out of this inflation scare, things are back to normal, you won't have the PSEI sitting at 6.4. You'll probably be sitting back at 8,000 already, right? So use this opportunity and use this entire crisis that's happened today as a chance for you to start preparing and how you can be positioning for the next leg higher.
That's great. Start positioning and prepare yourself for next year. Thank you very much for your time, Edmund, and it's been a pleasure having you.
Thanks, Marvin.